What will lead in the second half of the year? The same AI-related stocks, or will the market finally broaden in a meaningful way? Let's ask Adam Parker. He's the CEO of Trivariate Research and a CNBC contributor. He's with us out at our HQ. Welcome. It's good to have you out here.
Yeah, great to be here.
So you're pretty satisfied with where stocks have been for the first half of the year, and how does that color your view for where you think we're going to go from here?
Yeah, it's funny. We hold our big event this week. Trivariate does. We had 25 investors in the room. It was sort of interesting, everyone pitching ideas. Nobody pitched a short idea. It's interesting. In the past, that's been the case. And I'd say 11 or 12 of the folks used a different valuation metric to justify everything from next year's earnings to, I think somebody used an adjusted EBITDA in 2026 number, right? So people are really kind of starting. I came away thinking, wow, people are reaching for justifying the valuation to get their upside on some of these long pitches. It made me a little bit worried.
Wait, so you had 25 people in the room.
Yep.
And it sounds to me like you're describing I don't know, overwhelmingly is the right word, but pretty bullish group.
People weren't as cautious as I thought they were going to be, and that was one of my key takeaways. You know, my view is the financial conditions that we've talked about in your show for a year or 9 months, really since November of last year, being easy. That's what it says when you look at the Bloomberg number or the Chicago Fed number. When you talk to people on the ground who are, in real estate or, small business lending, it's a little bit tighter, right? So the question is private credit going to fill that void? Are we still going to see easy conditions? I think the second thing we talked about a lot is margins. And most people are sketching out lots of stock ideas. They can see margin expansion in the second half of the year.
Hey, but that's been a key part of your whole thing.
Yeah.
Okay. Your view has been colored since we've been having these conversations for the better part of 8 months to a year on the idea that margins are going to hold up. Right. And then stocks are going to do well as a result. That's been a key part of your thesis.
It is, and it still is. And I think, look, it's pretty tried and tested. Stocks where the margins go up tend to do well, and their multiples tend to expand. So I think right now, what do I think? I think financial conditions probably okay. Margins probably could come up. Estimates are a little bit too high. People probably lower in September. And I think the market can be okay. I don't think it'll appreciate in the second half of the year at the rate it did in the first. That's hard to sketch out another double-digit second half return. So I think we'll have some volatility in the late in the summer, but I think we'll end the year higher.
Are we going to be talking about the same kinds of stocks for the remainder of the year, or do we have a more meaningful broadening of this market? If so, what enables that to happen?
I mean, obviously the last month we've seen the narrow market again, the Mag 7 working. But if you look year to date, we've seen a lot of dispersion in every sector. It hasn't just been the Mag 7. We've seen, I think, every sector except for real estate's up. So there's been things to own. I sometimes go into these meetings, I do, thinking, like, what's the excuse everyone's going to use for why they're not keeping up? Is it going to be the concentration, narrow argument, or what's it going to be?
It's a reasonable argument to make. I mean,
if you're indexing,
it is what it is. Either you're in these stocks or you're not, and if you're not, you're hurting.
Right. If you're long only and you're indexed to the S&P, I think you have less than an excuse. Right. If you're at a hedge fund, it's hard to charge fees and then own them, so you got to carve alpha out elsewhere, and I think that's been harder. My general view, though, is that we're probably skewed to the upside still, just because I don't think we're going to see anything that destroys that dream of AI productivity. Most of my meetings, what people are saying is, when will we get frustrated that there isn't return on the CapEx investment yet for AI? Which are going to be the ultimate profit pool beneficiaries in AI? Is it going to be power? You've seen, VST and PWR rip higher. Is it going to be transmission and electrification industrial, Eaton high? Like, there's stocks you can point to that have done well. So people are trying to figure out, do I just buy the obvious stuff because we're still in the first inning of a nine-inning game, or is it going to pull back 30% and I'll get a second bite of the apple? So that's where my conversations about AI are generally centered.
So you said of 25 people in the room, it's an ideas gathering. Nobody pitches a short idea.
Yeah.
You've been coming to us pretty consistently, pitching some short ideas too. You've been thinking about those kinds of stocks. Are you, in turn, also reducing the kinds of things that you would even short?
No. I think for me, my framework, and we wrote a big note on Sunday, is, look, you need exposure to the themes you're confident to grow above GDP for the next 3 to 5 years. What are they? They're still AI semis, electrification industrials, housing, life sciences, and healthcare services, power. And then you want to avoid the things that I think are shorts, physical retail boxes, human being focused software, banks, things that real estate, commercial real estate, things that you think they're in excess for a while.